Something is happening in the silver market right now, and most people are completely missing it. Silver has been pushed down, bought back up, pushed down again, and yet it refuses to fall. Why? What is holding this market up? When everything around it says it should be breaking down, there is one level, one critical price zone that is about to decide everything. And when this level gives way, the move that follows will not wait for anyone to get ready. Stay right here, because what comes next changes how you see this market entirely. Welcome to John AG. This is the place where serious money conversations happen. No noise, no hype, just clean, honest analysis for people who actually care about where the world is heading. Now, before we go any further, Mo, if you have been around here for a while, you already know what this channel stands for. But if you are new here, do yourself a favor. Hit that subscribe button right now. Think of it like this. You would not walk into the best library in town, read the most important book on the shelf, and then walk out without ever coming back, would you? Of course not. So, do not do that here either. Subscribe. Stay. Because the conversations we have on this channel are the kind your future self will thank you for. And one more thing, drop a comment below and tell us where in the world you are watching from today. It does not matter if you are sitting in a quiet office in London having your morning tea in Karach or catching this late at night somewhere in the Middle East. We want to know because this story is not just about one market in one country. This story touches everyone. There is a particular kind of tension that builds in a market just before something important happens. It is not loud. It does not announce itself with flashing headlines or dramatic breaking news alerts. It is quiet. It is slow. And if someone is not paying close enough attention, they will miss it entirely. That is exactly the kind of tension that has been building in the silver market. And right now, that tension has reached a point where it simply cannot be ignored any longer. Silver has not been behaving like a market that is finished. It has not been drifting quietly into irrelevance the way a truly exhausted asset does. Instead, it has been fighting. Every time the price has come under pressure, something has pushed back. Every time it has looked like the floor might finally give way, buyers have reappeared. Not in a clean textbook fashion. Not in the kind of perfectly organized way that makes charts look easy and decisions feel obvious. The fight has been messy, uncomfortable, and at times deeply confusing for those watching from the outside, but the result has been the same each time. Silver has refused to stay down. That behavior means something. In the world of serious market analysis, how a market responds to pressure is often far more revealing than where the market actually is at any given moment. A market that collapses cleanly under selling pressure is telling one story. A market that absorbs that pressure, shakes, wobbles, and then steadies itself is telling a completely different story. Silver right now is telling the second story, and the people who understand that difference are the ones who will be positioned correctly when the next chapter begins. To understand why this matters so much, it helps to look at where silver is actually trading today. Based on current market conditions, spot silver is moving through the low 70s range. That may sound like just a number to some people, but in the context of everything that has happened over the past several months, that number carries enormous weight because sitting just beneath the current price is one of the most psychologically significant levels this market has seen in a long time. A major round number, a price zone that traders, investors, and institutions have all been watching with great intensity. Round numbers do something interesting to markets. They are not magical. They do not have some mystical power that forces prices to behave in a certain way. But they do attract attention. They become gathering points for human emotion. They become the line in the sand where bulls plant their flag and say, "This is where we hold." And they become the exact same line where bears sharpen their position and say, "This is where it breaks." When both sides are leaning hard against the same level at the same time, something has to give. The question is always which side gives first. What makes the current silver setup particularly interesting is that the bears have had every opportunity to win this argument and have not been able to close the deal. The backdrop has not been friendly to metals by traditional measures. Interest rates have remained elevated. The Federal Reserve held its policy range unchanged at its most recent meeting, with the effective Fed funds rate still sitting around the mid 3% area. The 10-year Treasury yield has stayed above 4.25%. The dollar index has remained firm. These are not the conditions that typically make silver an easy buy, and yet silver has not broken. That is the detail that serious observers are finding most difficult to dismiss. Because when a market refuses to do what the fundamental environment says it should do, that refusal is itself a message. It means there are forces operating beneath the surface that the simple headline-level analysis is not capturing. It means the story is more complicated than the standard framework suggests, and it means that whoever is buying this market at these levels against this kind of resistance is doing so with a conviction that goes beyond short-term trading instinct. That kind of conviction does not appear out of nowhere. It is built on something deeper, and in the parts that follow, that deeper foundation is exactly what this analysis will examine. For now, the most important thing to understand is this. Silver is not acting like a market that has given up. It is acting like a market that is under pressure but has not yet decided to break. That distinction, quiet as it sounds, is the entire foundation of what makes this moment so significant. The next move from here will not be small, and the level being monitored right now is the key that unlocks everything that comes next. There is an old saying in the world of serious market analysis. When something refuses to break under the weight of everything that should break it, stop asking why it has not fallen yet. Start asking who is holding it up, and more importantly, start asking why. That question is exactly where this analysis now turns. Because silver, by every conventional measure, should be under far more pressure than it currently is. The interest rate environment is not friendly. The dollar has not collapsed. The Federal Reserve has shown no urgent desire to pivot away from its current policy stance. The 10-year Treasury yield is sitting above 4% offering real competition for capital that might otherwise flow toward metals. On paper, this is not the setup that sends silver surging. And yet here, silver sits, stubborn, unmoved, quietly absorbing everything the bears have thrown at it. The question is not whether this is happening. The question is why. To answer that properly, one must first understand what silver actually is. Because silver is not a single thing. It is not simply a precious metal that people buy when they are frightened. It is not simply an industrial commodity that moves with manufacturing data. It is not simply a monetary hedge that rises and falls with inflation expectations. Silver is all of those things simultaneously. And that complexity is precisely what makes it so difficult to dismiss with a single narrative, and so dangerous to reduce to one simple explanation. On one side of the equation sits the traditional headwinds. Elevated yields create real opportunity cost. When a serious investor or institution can place capital into a treasury instrument that pays a meaningful return, the argument for holding a metal that produces no yield becomes harder to make. The dollar, while not dramatically strong, has remained firm enough to apply its usual inverse pressure on commodities priced in that currency. These are not imaginary forces. They are real. They are active, and they are working against silver every single day that rates remain where they are. But on the other side of that equation, something else has been quietly building, and this is the part that the surface-level analysis consistently fails to capture across multiple corners of the global economy. A slow but unmistakable shift in sentiment has been taking place. It is not driven by one event or one headline. It is driven by an accumulation of signals that, taken individually, might seem manageable, but taken together they paint a picture that is making a growing number of serious people deeply uncomfortable. Geopolitical stress has not faded. If anything, it has become more layered and more unpredictable. Energy markets remain nervous. Crude oil prices have stayed elevated enough to keep inflation conversations alive, long after many economists predicted those conversations would be over. Government deficits and major economies have continued to expand. Debt refinancing pressures are building quietly in the background, with enormous volumes of sovereign debt coming due in the near term at interest rates far higher than when that debt was originally issued. And perhaps most significantly, the market's ability to reprick risk almost overnight. A phenomenon witnessed multiple times in recent months has reminded institutional and retail participants alike that stability is never as permanent as it appears. That combination of factors has created something that does not show up cleanly on any single chart. It has created distrust, not panic, not crisis-level fear, but a low, steady, persistent distrust of the idea that everything is fundamentally under control. And distrust, when it reaches a certain threshold in enough minds, simultaneously tends to find its way into hard assets, not because those assets are perfect, but because they are tangible, finite, and immune to the decisions of any single central bank or government treasury. This is where the physical buyer enters the story, and this participant is one that purely technical analysis almost always underestimates. While traders debate levels and momentum bands and whether the next candle closes above or below a particular moving average, real individuals in real locations around the world are making a completely different kind of decision. They are walking into coin dealers. They are adding to allocated accounts. They are converting a portion of savings that once sat quietly in a bank into something they can hold in their hand. They are not doing this because a chart told them to. They are doing this because something in the broader environment no longer feels entirely trustworthy to them. That demand does not move in straight lines. It does not announce itself with a press release. It accumulates slowly, then shows up in the data only after the fact. But its effect on price is real. And when that kind of demand combines with a market that is already technically resistant at a major level, the resulting dynamic is exactly the kind of stubborn, frustrating, difficult to short behavior that silver has been displaying. The forces holding silver up are not irrational. They are not the product of speculation or wishful thinking. They are the product of a world that is quietly, steadily becoming more complicated. And complicated worlds historically have always found a way to remind people why silver has never truly gone out of relevance. The market is not broken. It is simply reflecting a reality that most headlines are not yet ready to fully describe. Most people look at a price chart and see numbers. Serious people look at the same chart and see something else entirely. They see decisions, they see fear, they see conviction. They see the fingerprints of every trader, every institution, every physical buyer, and every hesitant seller who has touched that market at that particular price. And when all of those fingerprints concentrate around a single level, when the same zone keeps appearing again and again as the place where everything changes, that is no longer just a number on a screen. That is a decision point. And right now, silver is sitting directly on top of one of the most consequential decision points it has faced in a very long time. To understand what that means in practical terms, one must first separate two things that the casual observer almost always confuses. There is a difference between a price that spikes through a level and a price that lives above a level. This distinction sounds simple, but it carries enormous weight for anyone trying to read what a market is actually communicating. A spike is noise. It is a moment of temporary imbalance, a sudden rush of buying or selling that pushes price through a zone before the broader market has time to respond. Spikes happen constantly. They mean very little on their own. What matters is what happens after the spike. Does the price retreat immediately suggesting the move was hollow and unsupported? Or does it hold, consolidate, breathe, and begin to attract new participation at that higher level? That second scenario is what analysts mean when they talk about a market living above a level. It is not about a single dramatic candle or a single explosive session. It is about the market settling into a new neighborhood, closing there, spending time there, behaving as though that previously contested zone has now shifted from resistance to foundation. And that transition, when it happens cleanly and with conviction, is one of the most reliable signals that a market's character has genuinely changed. Silver has not yet completed that transition. That is the honest assessment. What silver has done is something arguably more interesting. It has demonstrated repeatedly that the level beneath it is not empty. Every time price has been pushed toward that critical zone, something has shown up to defend it. Not perfectly, not without volatility or discomfort, but consistently enough that the market has been unable to establish a clean break below. And in technical terms, a level that keeps getting tested and keeps holding is not getting weaker with each test. It is getting stronger. Each failed breakdown adds another layer of evidence that demand exists at that price. Each recovery confirms that the sellers who pushed price lower were unable to find enough follow-through to make their case stick. This is the foundation of the current setup, and it leads directly to the level that every serious observer has circled on their analysis. The 70 zone, not as a magical number, not as a mystical threshold with guaranteed properties, but as the price area where psychology, positioning, and technical structure have all converged simultaneously. Bulls have defined it as the line they will defend. Bears have defined it as the line they need to break, and the market has been staging its argument around that zone with increasing intensity. What happens next follows one of two paths. The first path is the one the bears need to close not just an intraday dip, but a genuine session close meaningfully below that 70 area, with follow-through selling in subsequent sessions. That would shift the conversation entirely. It would signal that the demand which has been defending that zone has finally been exhausted. It would bring a new set of sellers into the market, participants who had been waiting on the sidelines precisely for that confirmation before committing to the downside. And it would force the bullish case to be rebuilt from a lower foundation, a process that takes time and carries real pain for anyone positioned on the wrong side of that move. The second path is the one the bulls are working toward, a sustained move above the contested zone, followed by consolidation, followed by the market beginning to treat that level as support rather than resistance. If silver can achieve that sequence, the next conversation shifts dramatically in tone, because once a major resistance shelf gives way convincingly, the market naturally begins searching for the next logical area where sellers may reappear. And in the current structure, that next meaningful cluster of potential resistance begins to come into focus somewhere in the broad vicinity of the 80 area. 80 is not a target in the sense that markets move on rails toward predetermined destinations. Anyone who presents it that way is oversimplifying. But 80 represents the next zone where historical price memory, round number psychology, and technical structure intersect in a way that is likely to slow momentum and force another period of consolidation in decision-making. Getting from the current level to that zone would not be a straight line. It would involve shakeouts, it would involve sessions that feel deeply discouraging to recent buyers. It would involve moments where the move appears to be failing just before it reasserts itself. That is not a flaw in the setup. That is simply how serious market moves behave. They do not reward the impatient, they do not accommodate the emotionally undisciplined. They move in the way that creates maximum confusion for the maximum number of participants before the larger directional intention becomes undeniable. Volume behavior has been adding another layer to this analysis. During the sessions where silver has come under the most intense selling pressure, the volume signature has not been the kind that signals genuine institutional distribution. It has been more consistent with the kind of technical selling that occurs when price approaches a key level and triggers stops or short-term tactical positions. Meanwhile, the recoveries, though not always dramatic in price terms, have shown a steadiness that suggests the buying is not purely reactive. There is an element of deliberate accumulation in the pattern. Quiet, patient, methodical accumulation of the kind that rarely announces itself until the move is already well underway. The levels are speaking. The question that now faces every serious observer of this market is not whether to pay attention. The question is whether they are listening carefully enough to hear what is actually being said before the decision gets made without them. There is a moment in every major market move that nobody talks about afterward. Not the moment the move begins, not the moment it accelerates, not the moment it reaches its peak, and everybody suddenly becomes an expert who saw it coming all along. The moment nobody talks about is the one that happens just before everything becomes obvious. The quiet, uncomfortable, deeply uncertain moment where the evidence is accumulating, but the conviction has not yet arrived. Where the setup is forming, but the confirmation has not yet printed. Where the people who will ultimately be right are still being laughed at, ignored, or simply overlooked by a market that has not yet decided to agree with them. That moment is right now. And what happens in moments like this separates serious decision makers from everyone else. The first thing serious decision makers understand is that markets are not designed to be comfortable. They are not structured to make the correct path feel obvious at the exact moment when acting on it would be most valuable. Quite the opposite. Markets are structurally engineered not by any single conspiracy or coordinated manipulation, but by the collective behavior of millions of participants to create maximum doubt at maximum opportunity. The move that eventually proves to be real almost always feels questionable while it is forming. The level that ultimately holds almost always looks like it is about to break, just before it definitively does not. And the participant who waits for absolute certainty before making a decision almost always finds that by the time certainty arrives, the opportunity has already repriced itself beyond reach. This is not theory. This is the observable, repeatable pattern of how serious money moves through markets across generations and across asset classes. And silver right now is exhibiting this pattern with textbook precision. The doubt is real. The discomfort is real. The sessions that looked shaky and the moments that felt like the floor was giving way, those were real too. But so is the recovery. So is the stubborn refusal to break. And so is the quiet, steady accumulation that has been building beneath the surface while the headlines focused elsewhere. The second thing serious decision makers understand is the danger of the single narrative. This has been touched on earlier in this analysis, but it deserves to be stated with full force here because the consequences of ignoring it are severe. Silver is not a war trade. Silver is not purely an inflation trade. Silver is not simply a Fed pivot trade or a dollar collapse trade or a fear trade. Anyone who reduces this market to a single explanatory theme is not analyzing silver. They are constructing a story that feels satisfying and then selectively gathering evidence to support it. That is not analysis. That is confirmation bias wearing the costume of analysis. And confirmation bias in capital markets has a very consistent and very painful ending. The real picture is layered. Elevated yields are a headwind. A firm dollar is a headwind. Opportunity cost is a headwind. These forces are genuine and they are active. At the same time, geopolitical instability is a tailwind. Distrust and institutional stability is a tailwind. Physical demand from buyers who are responding to something deeper than a chart pattern is a tailwind. Debt dynamics, deficit expansion, and the repricing of sovereign risk are all tailwinds. When genuine headwinds and genuine tailwinds are operating simultaneously at full force, the resulting market behavior is exactly what has been observed. Volatile, contested, frustrating, and deeply revealing to anyone patient enough to read it correctly. The third thing serious decision makers understand is the difference between monitoring a level and reacting to a level. These are not the same activity. Reacting to a level means waiting until the price moves dramatically, until the headlines confirm what the chart already showed 3 sessions earlier, until the social media conversation has shifted from skepticism to excitement, and then making a decision based on that emotional momentum. That approach consistently produces the worst possible entry points and the highest possible exposure to the shakeout that almost always follows a publicly obvious breakout. Monitoring a level means something entirely different. It means understanding in advance what specific price behavior would constitute genuine confirmation versus what would constitute a false signal. It means knowing which combination of close volume and follow-through would represent a meaningful shift in market character rather than a temporary fluctuation. It means having a framework prepared before the moment arrives so that when the market moves, the decision is already substantially made and does not need to be constructed under pressure in real time. That preparation is the entire difference between a strategic response and an emotional reaction. For the business community watching this analysis, for the aspiring entrepreneurs and serious capital allocators who understand that the macro environment is not separate from their operational reality but deeply embedded within it, the silver setup carries implications that extend well beyond the metal itself. What silver is reflecting right now is a broader truth about the current economic landscape. The world is not in crisis, but it is in a state of genuine sustained uncertainty that is quietly reshaping how serious people think about value, about preservation of capital, and about the relationship between financial assets and real tangible stores of worth. That uncertainty does not resolve itself cleanly or quickly. It tends to persist longer than comfortable, creating extended periods where the traditional frameworks feel unreliable and the standard playbook produces unexpected results. Navigating that environment successfully requires exactly the kind of analytical discipline that this entire discussion has been building toward. The discipline to separate signal from noise. The discipline to monitor without reacting emotionally. The discipline to understand that the market which is most worth watching is rarely the one generating the loudest headlines. Silver at the breakout point is not simply a trading setup, it is a mirror. And what it is, reflecting back at anyone willing to look carefully enough, is a world in the process of making a decision about value, about trust, about where serious capital belongs when the comfortable assumptions of the recent past are no longer quite as reliable as they once appeared to be. The level is being monitored, the decision is approaching,